Silver didn't break $100. It detonated the old rules. Because once silver prints 3 digits, this stops being a value play and becomes a momentum stampede. Your source confirms silver cleared $100, traded as high as $115.59 in spot markets, and pushed over $110 in Chinese futures. That's not a test. That's a new normal forming in public. And here's the paradox. The higher it goes, the more buyers show up, because triple-digit silver is a headline, and headlines pull money faster than charts. Now personalize it. If you're still waiting for $90 to feel safe, you may never get another clean entry. The market is building support above the breakout, while most people are still thinking in double digits. But here's the part nobody is saying out loud. When silver becomes a story, it doesn't climb like stairs, it gaps. And once the crowd accepts $100 as normal, the next number stops being a prediction and starts being a magnet. So the real question isn't, will it pull back? It's this. When the next surge hits, will you be positioned or watching it happen again? The core event is simple, but the pattern is bigger. Silver didn't just cross a level, it crossed a psychological border that has contained it for decades. The source frames $100 as the critical resistance, and above it, the market enters price discovery, where historical resistance is basically gone. That changes what every move means. Below 100, rallies felt temporary because the ceiling was visible. Above 100, the ceiling disappears, and the market shifts from arguing about value to reacting to momentum. Notice what that does to behavior. The wait-and-see strategy stops working because waiting was built for slow markets that revisit old ranges. This one may not. And the key detail is not the number itself, but the signal it sends. Triple-digit silver tells the public that something in the system is being repriced fast. So ask yourself one cognitive question that rewires the whole story. If $100 is no longer the ceiling, what exactly is silver being priced against now? Here's the strong claim. Time is collapsing, and that's why hesitation is getting expensive. The source compares the pace. Moving from $20 to $30 took 145 days, but moving from $90 to $100 took only 10 days. That's not normal appreciation. That's velocity. That's the kind of move you see when liquidity thins, demand surges, and sellers stop stepping in. And when the market can jump $10 in a week, the old investor rhythm breaks. Weekly analysis becomes too slow. Monthly corrections become a fantasy. This is where the story flips. Silver stops behaving like a chart and starts behaving like a crowd. Now watch how fast this escalates. Your source describes 150 as reachable within weeks, not years, and even floats 200 in the coming months. Whether those targets hit or not, the market is now conditioned to accept them as plausible. And that belief alone is fuel. Notice what they didn't deny. This phase is no longer about re-entry at lower prices. It's about surviving the speed. And the escalation isn't just price, it's infrastructure. Because when a market runs this hot, the stress doesn't show up first on your screen. It shows up in the plumbing. The source reports an emerging failure in the physical supply chain. Refiners have effectively stopped buying alloyed products like 90% junk silver and sterling, either refusing them or delaying payment from 10 days up to 3 months. That means the market is splitting in two. 0.999 fine bullion stays liquid. Legacy silver becomes sticky. And that's not a theory, it's a system constraint. This is where the story flips again. You can be up on paper while your exit gets harder in real life. Dealers can't tie up cash for months. Their business depends on speed. Buy, move, restock. So when the refinery window closes, the dealer window narrows too. And the dangerous part is how quiet it is. Most buyers will only learn this when they try to sell. But by then, the spread has already widened, and the line for liquidity is already forming. Now the second proof hit is even more revealing because it's coming from a sovereign signal. The source says the U.S. Mint repriced proof silver eagles to over $170 per ounce, roughly double spot at the time. That's not just manufacturing cost. That's an institution anchoring perception. It's a statement. We're not pricing for today. We're pricing for what we think is coming. Here's why that detail changes everything. If official pricing is already treating triple-digit silver as the floor, then $100 to $115 isn't being framed as a peak. It's being framed as a baseline. And it creates a strange distortion. The source implies buying from local markets near spot plus small premium can look like an arbitrage versus the Mint's official number. That's how new floors form. When enough buyers accept a higher reference price, the old one stops mattering. Notice the contradiction. Everyone says silver is too high, yet the institutions are pricing as if it's still early. Then retail mania arrives, and this is where rational pricing breaks. The source describes a whole new universe of uneducated buyers entering because of headlines and the visible decline in dollar purchasing power. It even frames a Veblen-like effect. Demand rises as price rises. Dealers report that even buying 6 figures of inventory daily, showcases stay empty because retail offtake is immediate. That's the pressure point. When retail starts buying without understanding, the market stops caring about fair value and starts caring about availability. And scarcity changes everything. Premiums widen, wait lists form, and the person who wants to be patient gets punished by empty shelves. But here's the part nobody is saying out loud. Mania doesn't just lift prices. It breaks routines. It forces you to buy during lulls, not during spikes. It forces relationships to matter more than charts. Because in frenzy conditions, dealers protect regular clients first and walk-in panic buyers last. The market becomes social, not just financial. The next layer is institutional capitulation, and it's quieter than people expect. The source reports there are 10 million shares available for borrowing to short silver, yet virtually no takers, calling it pure insanity to attempt. That absence matters more than the number. It means the old opposing force is gone, or flipped. When the short side disappears, the violent downside smashes become less reliable. Not impossible, but shorter, weaker, and harder to time. This is why waiting for manipulation becomes a trap. Your source claims banks that historically suppressed price have exited or turned net long, and names major accumulation as a beneficiary of the rise. So the market structure changes. Fewer natural sellers, less resistance, more air pockets upward. Now watch how fast this escalates. When the strongest hands stop leaning on price, volatility shifts direction. And the buyer who waits for a perfect crash may end up watching silver reprice in gaps, not candles. What happens if this continues? Now shift to you, because this isn't just a trade anymore. It's a lived experience. If silver is moving $10 in days, that's not market noise. That's purchasing power moving under your feet. The source links this demand wave to the public seeing the dollar's erosion in real time. And when that realization hits, it changes how ordinary people behave. They stop asking, is this a good price? And start asking, will it be available later? That mindset leaks everywhere, into savings decisions, into spending, into fear of being last in line. And the liquidity trap becomes personal. If you own the wrong form, like alloyed 90% that refiners are delaying, you might feel wealthy on screen and helpless at the counter. This is where the story gets real. It's not about being right. It's about being able to move. If this feels familiar, say so in the comments, because a lot of people are realizing the same thing at once. In fast markets, the only mistake worse than panic buying. Now, step back from emotion and look at the system that allows this to happen. The mechanism is simple. Momentum creates demand. Demand drains inventory. Drained inventory creates scarcity. And scarcity forces higher pricing even without new buyers. Then, Add the second engine, geopolitics. Your source frames geopolitical instability, conflict risk, war pressure, aggressive positioning as a persistent bid that keeps fear premium alive. This isn't a one-week headline effect. It's a structural background condition. The peace dividend mindset is gone, replaced by a world where surprises reprice assets overnight. That's why silver shifts from investment to insurance. And it explains why the old logic, sell when fear fades, fails. Because fear doesn't fade cleanly anymore. It migrates. One region cools, another ignites. And in that environment, capital doesn't seek maximum return first. It seeks survivability. That's how you get a market that keeps climbing even when it looks exhausted. Now the global center of gravity tilts, and most people miss it because they're staring at the wrong screen. The source reports Shanghai futures exchange pricing at roughly a $10 premium over Western spot, pulling physical inventory east through arbitrage. That means Western spot becomes a lagging indicator. The real pricing power shifts to where the premium is paid consistently. Any dip in US price becomes bait, because arbitrage buyers can buy the weakness and ship metal toward higher valuation. That creates a hidden floor under every pullback. So if you're waiting for a clean breakdown, you're fighting global flows, not just local sentiment. And the implication is uncomfortable. This isn't only about silver demand. It's about the dollar-based system losing its monopoly on pricing real assets. When another block consistently pays more, the market eventually converges upward. Or it runs out of metal. And the next move is already forming if that spread holds. Now the strategy layer. What do you do when silver outperforms and volatility becomes the cost of entry? The source highlights the gold-silver ratio compressing below 50-1, with gold near $5,000 and silver over 100. It even suggests historical paths toward 30-1 or 15-1. That opens two paths. Path 1, you hold silver for maximum upside, accepting that it swings harder. Path 2, you rotate strategically, locking in silver's explosive gains into gold's stability as the ratio drops. This isn't betraying silver. It's converting volatility into permanence. A staggered rotation means you don't try to nail the top. You reduce risk while keeping exposure. Because in late cycle moves, the market can reward you violently and punish you just as fast. The goal isn't to guess the exact next dollar. It's to keep your wins when the crowd turns the story into chaos. Here's the deep insight that ties everything together. Silver over $100 isn't just a price breakout, it's a behavior breakout. It rewires time, liquidity, and trust all at once. Your source outlines 3 futures, melt up to $150 and $200, structural grind above $100, or a worst-case liquidity trap where paper price stays high, but real-world selling becomes harder, especially for jump silver and tax jurisdictions. The smartest positioning isn't built on one prediction. It's built on product quality and optionality. 0.999 fine keeps you liquid. Dealer relationships keep you mobile. Rotation planning keeps you safe if the cycle matures. And if the next phase goes parabolic, you don't need perfect timing. You need discipline not to sabotage your own position. So don't treat this like a one-time spike. Treat it like the first visible crack in a bigger repricing cycle. If you want the next layer, how this ends, who gets trapped, and where the real exits are, follow and subscribe, because the story after $100 is never about silver. It's about what the system is admitting through silver.